Hello and welcome to this episode of Tech This Week, where we bring you updates from the world of startups, technology, and policy. It is the season of IPOs, with Zomato making its public market debut this week and payment companies MobiKwik and Paytm filing their draft prospectus with the markets regulator. Zomato's IPO has seen a warm response from retail investors who oversubscribed for day two trade by 4.7 times. Today is the final day for the food tech platform's $1.2 billion public offering. This week also saw MobiKwik filing its draft red herring prospectus to raise $255 million from the public markets. The latest entrant is Paytm, which filed its draft prospectus early on Friday to raise $2.2 billion from the markets. After gaming company Nazara Technologies, which was one of the first Indian technology companies to go IPO this year, it has been seen a promising lineup of startups, signaling the maturing of startup ecosystem in India. With this comes renewed investor interest in the sector. The week saw some big-ticket announcements when it comes to raising equity capital. US and India-based Netradyne, makers of AI-backed driver recognition and fleet safety platform for commercial fleet, raised $150 million from SoftBank's Vision Fund 2. Digital news aggregation platform InShots clocked $60 million from Y Capital, while global education loan provider Empower Financing raised $100 million from a group of investors, including King Street Capital Management, Drake's Landing Associates, and Pennington Alternative Income Management. Self-publishing firm for Indian languages, Pratilipy, has raised $48 million in a round led by South Korean gaming firm Krafton. Krafton, which also owns PUBG, announced the first esports tournament for the Indian Battle Royale game it had come out with, Battlegrounds Mobile India. Circling back to SoftBank, it made a comeback in Flipkart as part of the company's $3.6 billion fundraise this week. Flipkart is now valued at a whopping $37.6 billion post-money. The round was led by Singapore's Sovereign Wealth Fund GIC, Canada Pension Plan Investment Board, SoftBank Vision Fund 2, and Walmart. Other investors also participated in the round. Following this, Walmart-backed Flipkart announced a 600 crore rupees or $80 million ESOP buyback event for its employees. Around 6,000 employees now have the option to liquidate up to 10% of their vested ESOPs as part of the event. The company will provide an additional buyback of 5% of all vested options. Meanwhile, EdTech company upGrad also announced its maiden liquidity event of $29.5 million, which stands to benefit 37 early team members. This brings us to our guest segment. In our guest segment today, we are joined by Shabnam Shaikh, partner at law firm Khaitan Co, to talk about how ESOPs are now coming across as a viable part of compensation packages for startup employees given the liquidation events, whether through share buyback or IPOs for very large technology startups. Welcome to Tech This Week, Shabnam. Thank you, Shabnam, for agreeing to talk to Tech Circle as part of Tech This Week. We were looking at the entire gamut of ESOPs and the liquidity events which have happened this year because of the crazy startup valuations, and also the opportunities for employees in these startups because of a lot of IPOs which are lined up for later this year. To start with, Shabnam, can you tell us how has the appetite for ESOP changed, especially among tech startup employees as part of their compensation packages?
Sure. Thank you so much, Payal, for having me. It is a pleasure speaking to you today. So far as employee compensation in the form of stock options are concerned, it is a very, very prolific tool which has been used by startups over the years, given the fact that small startups are very limited in cash, but have limitless opportunity. And they do agree that the success of the startups early on can be attributed to the talent that they hire at the very beginning, which have good potential, and the growth of the startup is directly proportional to the kind of talent that you have hired. There are three things which are actually drive an employee to take up stock options. One is the kind of exercise price that I would have to pay in order to receive the shares. Second is until what time do I have to hold the shares in order to have some kind of a cash return. And third is invariably the tax consequences that could arise should I exercise my options.
And also, Shabnam, do you think that with the maturing of the startup ecosystem as well as increased capital which is coming in, the number of liquidation events in the ecosystem has gone up, and therefore employees are a little bit more secure about having ESOPs as part of their compensation?
Right now, it's not only the end game is an IPO or listing on the stock exchange, whether it be in India or on LSE or in some Singapore or New York for that matter. The thing is that a lot of PE funds are coming in and exiting. If one PE fund comes in, the other one exits, and so on and so forth. So there is some kind of a liquidity within the company itself in order to ensure that there is a buyout of the employees as and when the need arises. So the employees have some kind of faith in the fact that there would be translation of the paper that I have, the shares that I have at some point in time. So that kind of reassurance has been brought about because of so much of traction in the M&A space, in the Indian M&A space.
How do you differentiate between the two, and what benefits do each of these class of share components get?
There's something called as RSUs, which cannot be implemented in the Indian context. Restricted stock units are a promise that is given by the company that I will issue you shares at certain point in time, free of cost. Now, so far as Indian legal landscape is concerned, that is not allowed right now to give shares free of cost. You need to have some kind of an exercise price. So you find all of these RSUs more so being implemented in the US companies, where the issuing entity is the US company itself, because the US does give you the flexibility to issue shares without any kind of payment of cash. As and when I think the Indian law develops or matures enough in order to accommodate such kind of structures, we will have it. But so far as if an Indian company is implementing RSUs, it's just a change of terminology from ESOP to an RSU. US subsidiary who are issuing options or other units to their overseas employee, they could very well to go ahead and do it. And you're right, the more mature and the late stage startups would like to have RSUs in place because it's free of cost that is given and more at a higher level of employees rather than somebody who's lower than the CSEC level employees.
What kind of percentage of employees are increasingly coming under the ESOP pool, especially for companies you advise on structuring their ESOP pool, etc. So have you seen that the percentage, or as the company grows, increasing number of employees are coming in, or is it something which startups are beginning with at a very early stage?
So if you're talking about early startups, you would find the employee pool to be very, very limited, around 10 to 20, or even for that matter, 50 would be a very large number. So you'll find around, 40 to 50%, or rather all of them would have some kind of, pie in the cake by investment in the company or some. And those are called as the founders or, of the early stage startups. Not all 50 of them, but who have participated in the growth of the company at that point in time. But as the company grows, the proportion of the pool between the employees also gets limited, and to the point that only the people who are instrumental in the growth of the company would be able to get some kind of stock options. Now, if if your company is like dependent upon the large pool of employees at the ground level, startups have appreciated their contribution to the company, and they do want to give some kind of stock options to them, but it's not a large number. So if we like 0.5%, or that is also a lot actually, that would be reserved for employees which are lower than the management level employees, or a little lower than them. But so far as management and CXOs are concerned, you will find around 3 to 5% being reserved for those kind of employees. for the purpose of incentivizing them or remunerating them. So that's the trend that we are seeing, but it's more concentrated at the CXO and the management level.
How do investors stand to benefit when startups, have a structured ESOP pool early on in their life cycle?
So investors right now insist on having a structured ESOP policy, which is formalized in a way that is required. Now, for investors recognize that if the startups need to grow, they need to have right resources at early on, in order to grow the startups to a certain extent. So I have seen, investors seeing whether they have a structured ESOP policy or not, and after they have made an investment, they want an ESOP policy to be put in place. Because depending upon, if you have a CFO coming in or CEO coming in or, a technical guy coming in, you need to give them a promise of participation in the company's growth. Because at that point in time, the cash, so far as the startups are concerned, is limited. But I would see that from Series A onwards, you will find a lot of, the investors looking at whether the ESOP policy is there or not and insisting on having one in place.
Can you also tell us about how the employees look at the ESOP policy and what kind of provisions are being structured into the current ESOP policies, which are being framed by these startups right now?
So after the Companies Act of 2013 was legislated, which included some kind of the broad contours of, stock option provision that should be included in a policy document that is being rolled out by a company. We have seen that, the companies have gone far and beyond in order to think as to how should I treat the options in case there is a change of control. Whether should I have an acceleration of vesting? To whom should I be, giving the benefit of that acceleration of vesting of options? There's a distinction. Earlier, it was just, you write about it, there's termination of employment, then all the vested options will get, vested options will be entitled to be exercised, whereas unvested options would be cancelled. Now the companies are going beyond to think, okay, how do I distinguish between different type of termination? What happens if people are terminated because of cause, without cause, disability, death, retirement, and so on and so forth. So they have gone ahead and thought about all of the provisions beyond grant, vesting, and exercise, and how to ensure that when the shares are being given or the options are given, and if there's any change of circumstance, how should I deal with that? So those are the fine print of the documents that the startups or rather all the companies right now are looking at. And I think the employees are also becoming savvy enough to ask those kind of questions when they're being hired or when they're being, granted those options as to how my options will be treated. Should I leave the company before the vesting of options happen?
Thank you, Shabnam, for telling us about that. It sums up the basics of ESOP allotment in the Indian startup ecosystem. Moving on to the technology front, Google opened up its second cloud region in India in Delhi NCR after the initial announcement was made in 2020. Google Cloud, too, has benefited from the acceleration in digital transformation of companies and is turning up the heat on competitors AWS and Microsoft, which lead the race. Cisco will welcome its new India and SLAC president, Daisy Chittilapilli, in August. She takes over from Sameer Gade, who will be stepping down in July. An executive with Cisco for 17 years, Daisy Chittilapilli was till recently the managing director for Cisco's Digital Transformation Office. In other news, chat messenger platform WhatsApp banned about 2 million accounts linked to Indian numbers between the period of May 15th to June 15th, as per its first monthly compliance report filed recently. The report was filed as part of a mandate by the new IT rules. The report said that 95% of the accounts were banned as users tried to send bulk messages. In another policy move, Reserve Bank of India on Wednesday barred local arm of payments network giant MasterCard from onboarding new Indian customers for its debit, credit, and prepaid card offerings from July 22nd. RBI has raised concerns over MasterCard being non-compliant with the directions on storage of payment system data. And to wrap it all up, Two SoftBank companies, Swiggy and Ola, have been in news this week. Swiggy, which will soon receive $450 million from SoftBank after the path was cleared by CCI, is playing ball with National Restaurant Association of India. NRAI, for short, is the same association of restaurants which had said that food tech aggregators such as Swiggy and Zomato are exploiting restaurants based on anti-competitive practices and encourage their restaurant partners to ask customers to place orders directly with them. Swiggy will now service these restaurants for their direct orders and will function as a B2B2C service provider. Meanwhile, Ola announced pre-booking of its electric scooter for a refundable deposit of 499 rupees on Thursday without actually disclosing the actual price of the vehicle. Customers complained of glitches in payment and invoice generation, and CEO Bhavish Agarwal got on Twitter to say that the website did not anticipate the kind of demand it saw and all was well now. All eyes on the road for now. With that, it is a wrap on this episode of Tech This Week. Stay safe.